Hey guys, welcome back to the 9th episode of the Friday Ticker. In this episode, we're going to cover the basics of selling options contracts. So let's get into it. Now, before I get started, I am by no means a financial professional. I can't tell you what to do, when to do it, how to do it. These are just my opinions and my experience in the market. Okay, and I wouldn't consider myself an advanced options trader by any means. I am probably just a basic options trader. So, with that said, I'd also like to express that the best way to build wealth in general is to go long in the stock market over a 10, 20, 30-year period and just buy and hold for the most part, okay? But there is a temptation out there to play in the options market and to learn. And if you are tactful, you can make a decent amount of money with relatively low risk, I would say, when it comes to selling in the options market. So let's first get started by reviewing how an options contract works, the basics behind them, and then we'll talk about how to sell an options contract, okay? Now, before I get into the technicals of options contracts, let's talk about why they exist in the first place in the stock market. So if you've got a large position either to the long side or the short side, you may want to consider options as hedges, okay? Or sort of like an insurance policy. If you're concerned about the stock going down in the short term, if you're long, you might want to consider buying put options. Okay? And now put options are a leveraged instrument that are going to give you leverage to the downside. All right? You're going to make money if the stock goes down. Now, if you're short the market, you may want to go out and buy call options. All right. These are going to give you leveraged upside if that were to happen and pay you out. Okay. It's like an insurance policy. If you have an accident, let's say in your car, and you have an insurance policy, you get paid to cover your expenses. It's the same thing in the stock market. Okay. People buy options contracts as insurance policies to cover them on the downside or the upside. Again, depending on the position you're taking. Now, the thing about options contracts is that they come at what's called a premium. All right, you've probably heard of this. When it comes to paying for your auto insurance, you pay a premium to a company like AAA. Well, it's the same way in the stock market. Now, typically the people who are issuing insurance policies in the stock market in the form of options are the banks, hedge funds, maybe institutions as well, and retail. Retail can do this as well. Okay, you typically have to enable options on your brokerage account, and they will sometimes do a credit check because you can do what are called naked options, which I do not recommend by any means. I strongly recommend do not do naked options. That's where you're selling options contracts when you don't have the cash or you don't have the stock, either or, okay? And it depends on the type of options contract that you're selling. So be aware of this, okay? You can enable this in your account, but be careful, okay? So those are the four different institutions that are kind of selling premium on the market for people to hedge their position. Now, there are some people in the market who use call options and put options as gambling instruments, meaning they want that leverage. So instead of buying the stock, they'll buy a call option, okay? And they'll get that, exponential leverage if they think the stock is going up. Or vice versa, they'll buy put options if they want to go short. Now, the nice thing about buying a put or a call option is it does limit your risk as far as downside. What you put into a call option or a put option is the most you're going to lose. So it's a little bit of a nice instrument if you don't want to go short, because if you go short, you can lose to infinity. With buying a put option, you can only lose what you put in, okay? Now, before we get into how the premium is actually calculated, let's look at the mechanics of how options contracts work. The first thing you want to look at is the strike price, okay? This is where the holder of the contract, the person who bought the option, will have either the right to buy or sell shares, or they'll expire worthless. The contract will expire worthless. And that's dependent on the date, okay? The date of expiration, okay? Now, if the contract says that, let's say your expiration date is, let's just say 12/25 on Christmas Day, right? And let's say the strike price is $100, okay? Now, depending on the type of contract it is, let's look at the two examples. So let's say I bought a put option, okay? If I bought a put option with a strike price of $100, how do I get to exercise that put option? Well, I need the price of the stock to be less than 100. Okay, at any point before expiration, if the stock price is under $100, I can exercise that contract, and the seller who sold me those options has to buy the shares, and I get to sell the shares. I get to go short. That's what a put is, okay? And let's look at the other direction, okay? Let's say I buy a call option, all right, and the strike is $100. That means that the stock price needs to be greater than $100. Okay. Now, I don't know what happens when it's equal to. I'm not exactly sure. I'll have to look that up. But anyways, if it's greater than $100, I get to buy the shares from the seller of the contract, meaning they would have to hold shares and sell them to me if I was the buyer, okay? So that's kind of the basic fundamentals of options, okay? So let's erase all that. And then let's talk about that thing called the premium, okay? Now, the premium is kind of interesting. It's based on two things. One, intrinsic value. Yeah, we'll put it under it. Value. And then it's based on time value as well. Okay, now the intrinsic value is when the stock price falls either below or above the strike price. Okay, so remember that strike price of $100 we went with? Now, if the price of the stock is, let's say, $98, and I was selling a put, okay, meaning now the stock is $2. There's a $2 difference here in the money, under $100 when you're selling a put. That means the intrinsic value is $2. Okay, so the premium on that contract is going to be somewhere around $2, okay, for a single contract, okay? Now, the time value, okay, this is where the contract can go from, let's say, 1 week. It could go for 1 month. It could also go for 1 year, okay? And the farther out you go, the more risk the seller is taking by holding the contract. So if I hold the contract for, let's say, 1 week here, it's not very much risk. How much is the stock going to move in a week? You know, probably not very much, okay? So we'll just say it's little, okay? And then maybe a month, that's a medium amount of movement in the stock. A year, the stock could drop maybe 50%, do I want to take that risk? If I do, I'm going to ask for a higher premium, a longer time period. Okay. Now, here, we'll erase this. We'll say this is large amount of possible volatility or risk. Okay. Now, the market judges how much risk is involved, and it's done so by this thing called implied volatility. See if I'm spelling it. Or IV. Okay. You'll hear a lot of stock traders and options traders talk about IV all the time. They'll say things like IV crush and things like that. Well, the IV is what's going to give you premium based on time. Okay. The more demand there is for a put option or a call option, the IV goes up. And when that goes up, it gets factored in the calculation for the time value. Okay, the more time value you have, the higher the premium you're going to get, but the higher the risk you're going to have by holding the stock if you get assigned shares, which we'll talk about in a minute. So hopefully that makes sense. I know it's a little complex, but at the end of the day, it's time value and intrinsic value. And let's go back here for a second. I'm going to erase this. Okay, so coming back to intrinsic value, this is typically when, again, we're in the money, okay? Meaning the stock is trading currently under the strike price or above it if you're selling covered calls, all right? But time value is interesting. That's where really the money, the premium is involved, okay? So I'm not going to talk about intrinsic value very much, but I'm going to talk more about time value. So you can be out of the money, which is OTM, meaning if you were selling a put, you would be selling it when the price of the stock is above the strike price, okay? And then at the money is right at the strike price. So if I sold some puts when the stock was at $100 and the strike was $100, that's at the money. And all the premium you gain is time value, okay? If you sell in the money, ITM, you're getting both time value and intrinsic value. You're selling both at that time. Most people, depending on their strategies, are most likely, let me erase this, are most likely trying to only sell time value. Now, some people do sell in the money puts because they want to get assigned typically, and they want less volatility in the instrument because it has some intrinsic value still with that option contract. But for purposes of this video, I'll give you an example of where I sold time value for a stock just recently. So let me erase all this. So my most recent trade was on AMD, okay? AMD. They had a massive deal with OpenAI and the stock spiked like 30% overnight. It was pretty insane. And I saw it selling off quite a bit, all the way from 230 on the open down all the way to about 205 is where it got down. Now, I sold these put options when the stock price was around $212 a share. That's where the stock price was. And I sold a strike of $200. Okay? So if the price of AMD goes below $200 by October 24th is my expiration date. That's when I pick the expiration date. It's usually on a Friday. Options always expire on Fridays. So I've got about 3 weeks. And I sold those contracts. I sold 5 contracts, Now, I failed to mention that, contracts. I failed to mention that each contract is worth 100 shares. Okay, so 5 contracts times 100 equals 500 shares. That's what I need as collateral to fulfill this contract if it expires underneath $200. Okay, I'm going to have to come up with 500 shares. So what does that mean? Well, 500 times 200 is $100,000 in cash is what I'm going to need to pony up to buy 500 shares from this put holder who's going to want to sell shares. Okay, so that's the option that I sold, which is interesting. It's all out of the money. So this was out of the money when I made the trade. Okay, so everything I was selling, which equated to $3,000 in premium. That's the risk that I'm willing to take on this trade if I were to be exercised. Now here's the thing about it, right? So let's erase this a little bit. You saw what I put up. Now let's go back to where that strike price is, okay? 200, okay? I sold I have 500 shares involved, okay? So each dollar that the stock goes down, let's say the stock goes to $199, I'm out $500, okay? Because I own 500 shares. Each dollar is $500. So 198, I'm down $1,000. 197, I'm down $1,500. 196, I'm down $2,000. You guys kind of get where I'm going? If the stock is at 195, I'm at 2,500. If the stock is at 194, I'm going to be down $3,000 from my initial buy-in at 200. However, I collected $3,000 in premium to take this trade, to take on this risk of selling an options contract. So my break even is right here at 194. Okay, if the stock, let's say at expiration, closes at 194, I'm at break even because I collected 3,000 and I lost 3,000 on the share price. Okay, now anything below that, then I'm really in the red, which happens all the time in the stock market. Okay, options contracts are never guaranteed to always be keeping you in the green, but they do give you a sense of safety as far as like you're buying it at a discount. I'm really buying 500 shares at $194. That's really what I'm doing. I'm getting them at a discount. Now, the only disadvantage, okay, and this is basically today, is, Now this is interesting. Now, I could have instead decided to buy the shares outright, 500 shares at $212. I do have the money to do that. And with that, I would have been exposed to all the upside of AMD over the last 2 days. Now, AMD is trading at $240 as we speak right now after hours. So I missed out on what? $28 a share. So if you take that and divide it by 2, that's 14. That's $14,000 that I'm missing out on. Instead, I sold $3,000. Okay, now you might say, Dan, why didn't you just buy them? Well, with that kind of move, a 30% move, that can drop on a dime. I've been in the stock market for a number of years. 212 can be 190 in about 5 seconds. Okay. And so I would have kept holding that stock. I know it would have gone back up to 230, 240. I was pretty confident in it, but I didn't feel like stressing about it. So instead, I sold a put for $3,000. Now, what's interesting about this this move is that, like I said, the stock in 2 days moved from 212 to 240. And today, the implied volatility, the IV, on the 200 strikes, okay, got crushed. The IV crush came in because the odds of me getting assigned shares at 200 are way down now. So that premium, okay, that I received, the $3,000, okay, went all the way from $3,000 down to $1,100. Oops, sorry. $1,100. Okay, I could have sold the position. I could close the position. You can buy back the puts. All right, the same contract that you sold, you can buy them back. I could have sold and closed, or I could have closed out the position for what is around $1,900 in profit today. But I figure I don't think these things are going down to 200. So I'm going to try to collect this last $1,100. This was a total of like a 61% gain in 2 days. Okay. Pretty incredible move. I'm pretty happy about it. Again, it could, the stock could go all the way from 240 back down to 200. And then I'd be in that position where as long as it goes to 194, I break even, I get assigned the shares, and I'm not going to complain if I get assigned 500 shares of AMD with that OpenAI deal. I think this thing is going to $1 trillion, $2 trillion in the next 5 years. So I'm not really concerned if I do get assigned shares. But that's kind of the gist of how this game works. It's a risk-reward type of scenario. I'm not going to have huge reward on selling put options. I'm going to have a little bit of risk, but a decent amount of upside. I mean, for me, with 100 grand, $3,000 is still good money. That's 3% of my total position size. So I'm still pretty thrilled with that. But yeah, there's lots more details to options. I think I've been going on for quite a long time in this video. I know it's a lot to take in, but maybe this is just a kind of a brief introduction to options and a simple example of how they work, how they're working for me. I do have other trades right now that I did get assigned shares because I sold them in the money and I didn't mind getting assigned shares. And now I sold covered calls. I sold covered calls on UPS and Target. And so, I'm making money on the other side. Calls is the complete opposite, okay? And we can go into that in a future video down the road. So, but let me know if you guys have any questions on this type of content. It is difficult to explain. I had to work with ChatGPT to kind of even understand if I was correct on some of this stuff. And so it's pretty complex, but the more you do it, the more you get better at understanding how the mechanics works. But, if you are going to do it, take your time, really study it, and only do one contract at a time for probably a low price stock. That way you get used to it. You get a feel for selling puts or selling covered calls, and you feel comfortable with it before you go into, selling $100,000 worth. It's, it can be stressful once you get assigned because now you're holding the stock and you got to know what to do, and you got to be, you can't be emotionally compromised in this game, okay? It'll get the best of you, trust me. So anyways, let me know in the comments below if you have any questions. And if you could, like and subscribe to the channel if you like this content. Take a look at my previous video. And everyone have a great day. Thanks. Bye.